My name is Paola Gonzalez, and I work for Nevada State Development Corporation.
And my name is Cathey, and I am a commercial real estate broker and investor, and work with Paola pretty often and call her all the time to ask many questions. I figured we should just chat about it and record this so that we can serve as a resource to everyone.
I work with the SBA 504 loan program, and we provide the program for small business owners looking to purchase their commercial real estate that will be owner occupied. And so we can provide up to typically 90% loan to value or loans. And we do that because we partner up with local financial institutions, and they provide a portion of the financing, and SBA provides about 40% of the project cost. And then the small business owner only has to come in with a 10% down payment.
And the 10% down, though, I know you've explained this to me before, that it's for established business owners. So that means they need 2 years or more of financials, and that's official financials via tax returns, correct?
That's correct.
Okay.
So if you aren't a business owner that has been in operation for at least 2 years, that equity injection or the down payment that sometimes people refer to will increase. Instead of it being a minimum of 10%, it will be bumped up to 15%. And so the structure changes a little bit. The bank will still be at 50% of the project cost. SBA will provide about 35% of the project cost, and then the small business owner comes in with 15%.
And there's a lot of differences, not just the down payment, but also like the loan terms. I know there's commercial investments that I personally own and a lot of my clients have. They have much higher down payment requirements, but also the amortization period. I think that's an important point to touch upon, because if people are familiar with commercial investment loans, the amortization doesn't always match a term, but in your case, it does. Right?
It does, and that's one of the benefits of having an SBA 504 loan. So SBA provides fully amortizing fixed rate loans. So we do have 3 different types of debenture or loan terms, and so SBA offers a 25, a 20, and a 10. And so if a borrower would decide to take the 25-year term, that is a fully fixed loan, so your payment does not change for 25 years. And our rates are usually well below the market. Currently, our current June rate was at 2.88%, which is unheard of, because that is fixed for the life of the loan.
Yeah, but that's for the SBA portion, right? So that's
correct.
40% of the loan, and then you guys usually partner with a traditional bank on the 50%. And what's the blended rate that you've been seeing recently?
So typically, the only requirement that SBA has of the bank for their portion is to at least provide a 10-year term loan. Normally, they'll provide a 10-year term with a 25-year amortization. And like you said, on those type of terms, you're going to have a balloon payment after 10 years. But because they're partnering up with an SBA 504 loan, usually the rates are much lower than if you were just to go into the bank and say, I want to buy this commercial building. What are your conventional terms? So we have been seeing banks provide a range between a low 4s to sometimes as much as 5%. So the blended rate, could be still in the mid 3s, depending on what the bank is offering. And so that is something that the bank and the actual borrower will negotiate between each other. But again, the risk is reduced because the bank is now only retaining 50% of the portion. So typically you'll get a much better interest rate even on the bank portion.
Yeah. And what has historical rates been like before this? Because I know they're at historical lows. I've been in commercial real estate over 10 years now, and I've seen more buyers than ever. I feel like in the past people were always leasing, and I think because the numbers worked out better back then because of the interest rates. So what was it before all this? Like, was it more in the 5s, or was it?
So I have been with NSDC for about 6 years, and so 6 years ago we were probably in the 5% range, but we have had rates in the 3.5% for at least 3 years now, and they keep declining. I know we thought for sure that there'd be some type of increase to the rates, but the last couple of months they've declined. Not by much, but still, a 2.88% rate is phenomenal. So
I know, I'm like, on the investor side, we're like, that's almost like free money.
It is
especially
free
with
money.
Inflation the way it is, right? So,
exactly, yeah.
So that's great, yeah.
We wish we could offer it to investors as well,
Right.
but SBA is very specific that it has to be offered to a small business owner in which they have to occupy the building. There are some occupancy requirements. So let's say that you have a small business owner that's been leasing for years and decides, nope, this is the property I want to buy. If it's an existing building, they must occupy at least 51%. If they want to purchase land and construct, go vertical, SBA does require that they at least occupy 60% of the project that they're building. And the idea is, hey, if you're buying something and you're constructing it, you're tailoring it to your needs.
Yeah.
So you should be able to occupy more.
Oh, so that's for more ground up or redevelopment. That's 60%, but
For ground up, yes. So if it's an existing building and they want to do some tenant improvements, that is only the 51%.
Okay.
So existing building, 51, existing building with TIs or tenant improvements, also 51% occupancy. If it's ground up, that's when we require a little more of the borrower to occupy the building.
Yeah, I think the 51% aspect is really interesting because I think that's one portion that a lot of my clients didn't know. They're like, oh, I thought I had to occupy 100% of it to utilize an SBA loan. And the way I've explained to them, it's kind of like on the residential side, you've heard of house hacking, or a lot of people have heard of house hacking, where you may buy let's say a duplex or a fourplex, and you'll occupy one of the units and rent out the rest. Similar concept with commercial, where they can occupy 51% or more, rent out the remainder, but sometimes and oftentimes the remainder is more than what that tenant like, you know what I mean? So I guess put an example, it'd be easier. Basically, like, let's say the owner, the SBA borrower is occupying 60%, they're renting out 40%, but that tenant might be paying 50 or 60% of their monthly payment.
Absolutely.
That's what I've seen a lot. Is that kind of in line with what you've seen recently
as well? We have seen that as well. And so when we are underwriting a deal, so that's a very good point. When we're looking at a deal, we want to make sure that the small business owner can support the entire debt service. And so we understand, and of course we understand that they will be receiving some type of lease income, and that's gravy for them. But for us, when we are actually looking at it, we're making sure that the small business owner can support the entire debt. But it is a great option for them to have some passive income on the side.
So that's an interesting point. So you're not using the rental income to qualify, even if there's a long-term tenant in place already?
Correct,
okay,
yes.
So the business has to qualify solely on their own income?
They do, yes.
Okay. So
because again, SBA, the focus of the 504 program is for the small business owner to be able to utilize the program to step into something that they're going to own, and not necessarily for additional or passive income.
And then how much do personal financials affect a business looking for SBA loan? Like, is their personal credit weighed really heavily, or their personal net worth, assets, liabilities? Like if they own a vacation home, and their primary residence, is that taken into account, or are you solely looking or mostly looking at the business side?
So we're mostly looking at the business because, again, we want the small business to be able to support the debt service. However, we also look at the principals, right? What kind of strengths? Because at the end of the day, if the business can't support it, and we are looking at the principles to be able to support and enhance that. So when we're looking at it, we are analyzing out on the global picture. And so we are taking into account everyone who owns 20% or more of the business. We're looking at their strengths and weaknesses. So we take into account their credit, as well as their personal cash flow, as well as their assets and liabilities that they own on the personal side. But again, the main focus and our primary source of repayment is that business.
Interesting, yeah. Like, is your ratio then like similar to a residential loan or something like that, or like investment loan? I think they're like 1.25 debt coverage, things like that.
So in the SBA realm, we look at on a standalone basis. So the business, we want them to be at least at a 1-to-1. If we are looking at it on a global basis and bringing in that personal excess cash flow, then we're looking at it at a 1.15 debt coverage ratio. Now, even though SBA is a little more lenient, let's say, when we're looking at that debt coverage ratio, we have to keep in mind that we do have a participating bank, and that bank is always going to underwrite with their credit policy. And so typically the bank still would require at a minimum that 1.25.
Interesting. And what are some of the reasons that you've heard from your clients that are, why they chose to buy over lease? I know we've talked a little bit about this in the past, is it more the depreciation or what? Like, what are your top 3, top 5, whatever you think?
I think it's a combination, right? I think it's a combination knowing, hey, I've been paying somebody else's mortgage for years. Why not pay my own, right? I'm creating some type of value and wealth by owning an actual piece of real estate. Definitely the write-off of depreciation that they don't normally have if they're paying just rent. So it's a combination of all. And with today's rates being so low, most times it is less expensive to buy your own building, pay a mortgage, than it is to lease.
Yeah.
So it just makes better sense. And we always tell our clients, talk to your CPA. The numbers don't lie. And, work it out and see. Do the math.
I know, I'm big on that. Do the math. I mean,
Yeah.
I know we've ran a few of those own versus lease analysis together, and I've definitely seen that. The payments usually are lower, just coming up with that down payment. But what I've realized with a lot of my clients too is that, and I think it's interesting, we should, that you can build in the construction cost. Because a lot of times what they've realized is that, they think I have to come up with this 10 or 15%. But if you're coming up with the equivalent of that in tenant improvement allowance, like for your proportionate share of the tenant improvements, then your out of pocket up front is the same, right? Because that's one of the main differences as well, the construction
definitely.
being built into it.
Yes, versus the lease and having to pay out the tenant improvements.
Yeah, so in the lease situation, I've worked with a lot of commercial leases, and the landlords will contribute, but it's definitely more of a landlords and sellers market today, so they're definitely not as giving as many concessions as they were. And so maybe before, if they were willing to give 50% of the TI allowance, they might be giving 20 or 30% because they have options now. There's other offers. There's tenants willing to take the space as is or front all their tenant improvement allowance. And so I've seen tenants seeing these counter offers coming back where they're contributing a hefty amount out of pocket.
Absolutely.
And so it's interesting, like, is there kind of like, what have you seen, like, in terms of, is there a cap or something on the construction? Like, if it was a restaurant and a full build out, is that feasible, or is there a cap per square foot on tenant improvement?
There isn't a cap.
Okay.
I mean, at the end of the day, we can wrap in all the tenant improvements in the project. And so when we wrap in all of the expenses, so the purchase of the building, let's say, the tenant improvements, all of the title fees, eligible costs that we can include, that is how we determine what that 10% equity injection. And most times, to your point, is going to be much less than, again, putting those tenant improvements towards a leased space. We don't see a cap necessarily depending on industry, but at the end of the day, we do require an appraisal, and that appraisal will have to support our project cost. And so in this market, we haven't seen many appraisals come in with shortfalls, so it's a good time.
So the appraisals, do they include, what if it's like a gray shell space and then they need to do a full build out? Like, when does that, how do they appraise that then? Because the gray shell is going to be worth very different than what a fully built out restaurant is, for instance,
And so we require, as part of our due diligence and for the project, is to have a detailed construction bid come in. So when we are approving a request, not only does it include the purchase price of the gray shell, but it also has a component of the tenant improvements. And so when we engage an appraiser, or the bank engages the appraiser, we'll ask for an as-is value, which should come into the purchase price of the gray shell, and then an as-complete value. And so that as-complete value is determined based on the construction bid we've received, as well as some type of sketch and plan of what they're intending to do in that building. So yeah, and we will land off of the as-complete value.
Oh, okay. That's good to know. So is it, but they're still paying just that one appraisal fee, right? Are they paying extra?
No. It's one appraisal, and it will have two different sets of values, for the as-is and then for the as-complete. And so we look at the as-complete value.
And on that note, we should start talking about some of these fees and closing costs. Kind of like what's associated with it. What do you require in order to like qualify them? I know on the leasing side, it's usually 2 to 3 months bank statements, 2 years tax returns. Very simple and straightforward. But I don't know, on your end, you guys require more than that, or?
Well, we require a little more. So there will be SBA application documents that will have to be reviewed and signed, because SBA is very specific on who we're lending to. But on your typical financial package, it's the same thing as you normally would require or a bank would require. So it's 3 years of business tax returns, an interim statement of your business, because we want to know historically how well has your business been doing, and then what it looks like today. And then we will also require 3 years of personal tax returns and a personal financial statement on any of the owners that own 20% or more of the business. So not too bad. Everything at your fingertips, or at your CPA's fingertips.
Not too bad. And so for some of these business owners that may be too busy, they can just connect you with their CPA and have them kind of coordinate everything directly? Have you done that? Is that
Absolutely.
Okay.
You know, we try to make the process as
Yeah.
easy as possible. So if they are willing to share the information on who we can contact, we are happy to make contact with them.
Okay.
And the nice thing is too is that once we are brought into the project, if they haven't picked who they want to work with as a financial institution, we will make that connection as well and make sure that we're sharing the file so that the borrower doesn't have to worry about, oh great, here's another document or list of items that are needed. So we really truly try to work together as a partnership so that we can make the process as easy as possible.
Mm-hmm. And then what are the fees if someone wants to buy? Like, how much should they prepare to come out of pocket? Is it just that 10%, or are these appraisals and inspections and everything on top of that? So is it 10% plus X thousand of dollars, or is that built into that?
So we always try to build into the loan as much as possible, but again, it's that appraisal that has to support all of those costs.
Yeah.
And so if the appraisal, or excuse me, if the value in the appraisal supports, we can include that as all the total project costs.
Okay.
The thing to keep in mind though, most of the time the bank will require at least like an earnest money deposit of about $5,000, and that will actually be used towards the environmental report as well as the appraisal. So that will be a check that they will have to actually write. The good thing is that we can actually use that towards their 10% equity injection. But it's typically someone's writing a check immediately for that amount. And then most of the time, I want to say 98% of the time, we can wrap all of those fees in the loan. And so really, truly, it's 10% of the total project cost.
Yeah. Okay, so that's another big difference then between an investment property and you guys, because an investment property, especially on the commercial side, there are so many fees.
There are, and they usually want you to not only put here's your 30% down, 25% down, plus all of these fees.
Exactly.
So yes, no, we try to make it as easy as possible. So it's a true 10% then? It is a true 10% of the total project though. So a lot of times people will consider and say, oh, it's 10% of my purchase price. No, it's not that simple, because the project costs are going to include not only the purchase of the building, let's say there's tenant improvements. If there are tenant improvements or any type of construction component, the bank will also include an interest reserve, a contingency line item. So once we figure out all of the uses or how the loan is going to be used, then that's when we'll calculate that 50-40-10 structure. And so then that 10% is of the total project cost.
Yeah, so so those reports, the appraisal, the phase 1, all that gets added onto the...
Correct, yes. Yeah.
Okay,
So
that's interesting,
it is, we try, again, and the borrower can decide that they don't want to include it as part, but I don't think I've ever had a borrower that said, no, I don't want that as part of my project cost. Again, they try to include that, especially with the rates being so low, amortized over such a long period of time. The idea of the program is for them to retain as much cash in their business as they can, because we want them to be able to use that liquidity by hiring other employees, if it's using proceeds or for marketing. It's however they want to use it to enhance their business instead of having to put it into real estate. So
and I mean, it's nice to have a fixed payment too. I know I've had clients that are like newer business owners ask me, they're like, why does my rent have to go up every year? I'm like, because the landlord needs to make money.
Exactly.
They have their pro formas to meet. They have their lenders and their equity partners and investors like pro formas to meet. And about 2 to 4% I think is most common for commercial per annum increases on rent. But that's the other, I think,
positive
major benefit of a loan where you have a fixed payment, and usually for 25 years seems the most common. Is that, or?
So actually, SBA just started, it's probably been about 18 months that they've offered the 25-year term, and I want to say that most clients will take advantage of that term. But it's probably our most popular term. Sometimes they'll go into the 20, very, very rarely we'll do a 10-year term. It's usually when a customer is trying to buy equipment, because the 504 program can be used, again, for any type of fixed asset purchase. So if it is equipment, then most of the time we'll put them on a 10-year term. But either of the three options, you'll get your rate fixed for the life of the loan, and your payment does not change.
Oh, so they just increased the 25 year?
About 18 months ago.
Oh, wow,
Yeah, 18,
okay.
24 months, yeah.
So that might be a big differentiator too, because I was wondering, I was like, why are so many more people buying now than leasing?
Yeah,
if
it's been insane.
the qualifications are vastly different now, because I'm like, I'm used to more the investor side. My family's been investing in commercial for so long, so I'm used to like, the 30 to 40% down, the 1% lender fee, all the thousands of dollars for the closing, and I'm like, so this is really interesting to me too, to like learn the differences.
Yeah, and hopefully take advantage for your small business.
Yeah, I was like, right now, luckily, our office is in one of our investment properties.
Oh, there you go.
So we're kind of paying ourselves rent. It's okay.
Yeah. Makes sense. So.
But that's interesting. Okay. Is there anything else you think like new borrowers, new business owners should know, or established business owners that are looking to transition? Like what should they know about the SBA loan? What are the top questions you get, or top things you tell clients?
I think it's just that you'll be able to get it's very small equity injection, only 10%.
Yeah.
Your rate is fixed for the life of the loan. I mean, it is unheard of to actually get a rate that's fixed for 25 years. In the commercial world, I think everybody is used to, when I buy a house, you expect a 30-year mortgage, and it's fixed for 30 years. In the commercial world, most people who are familiar in that world know you will not have that type of term or that type of rate. So I think it's just taking advantage of that. And knowing that we are here to help you and the small business owner and try to make that transition from being a business owner that has leased for years to now someone who's going to own their own real estate.
Yeah.
So.
Yeah, I think like touching upon that, the commercial loans, that's what I'm familiar with. Like I said, we've done, it's usually 5, 7, or 10 year, and there's a balloon payment due at the end of it.
Oh, wow.
And when you need to refi, you're paying thousands of dollars, or sometimes over $10,000 to refi, and basically trade paper, honestly.
Well, it is because you need a new appraisal, you need new title insurance, so you don't have those kind of costs when you're working with a loan that is for 25 years, right? So you pay it once, and you hope you don't have to pay it again, unless you expand and want a second location, and we can help with that too. So.
Okay. Oh, so people, if they're expanding, if they have one SBA loan, they can use another?
They can have multiple SBA loans.
That's something new I didn't know about.
So if you are, again, keeping in mind that it has to be owner occupied. So we have several clients who have come back and used the program several times because they've expanded their operation. Maybe they have multiple locations of restaurants, or you have multiple gas stations and you want to come back and use the program. You're allowed to use the program. Now, with the SBA, we do have a max of $5 million.
Okay.
But not for project. And a lot of people say, oh no, I thought $5 million is the max project. It's just our debenture amount. And there are rules that we can go above that. So if we have a client who wants to come back and say, oh no, I'm almost at my $5 million max, we always tell them, let's talk through this, because there are ways, there's always exceptions to the rules that we can actually get more funding. They can add solar, and that will increase their availability. So there's ways around that we can get a little more than the $5 million. But we are maxed out at $5 million per project.
Oh, that's really interesting.
So there you go.
Yeah, learn something new. I'm always learning.
Good.
Well, thank you so much for your time. It's very informational, and I hope this is helpful for everyone that sees this.
Perfect. Thank you.
Call Paola Gonzalez or call myself if you guys have any other questions.
Sounds good.